All right, what we're about to do is we're about to do a as is. So I'm going to name my file the as is and a final valuation of Coke. This is using the file that we had completed last Wednesday on Coca Cola. So remember, with this file, we pretty much had put in the valuation tabs and we had forecasted out the ratios for 10 years. So right now, Coca Cola share price, if we look it up in the marketplace today, is trading at around, it's around $41 a share, $41.12. So when we do an as-is valuation, this is one of the two valuations we're going to do for your group project and for your future assignments, is that we're trying to come up with a model share price that's within $1 of the current share price for Coca-Cola, right? Because part of the assumption is that in Bloomberg, if you were to go to Coca-Cola US equity and type in HDS, which is holders, that'll tell you the owners of Coke stock from largest to smallest shares. What you'll see for most large companies, Coke's no different, is that the top 18 institutions own 65% of Coca-Cola stock, right? And so we now see such concentration amongst big institutions owning company stock that really it's these institutions, and you notice Warren Buffett's Berkshire Hathaway owns the biggest amount at almost 9%, but these institutions are basically setting Coke share price. So these institutions are using sophisticated models, DCF models, kind of like the one we have built, to value Coke. So really what we want to do is we want to kind of work backwards to say, okay, given a $41 share price, what assumptions did they put in for cash flow that basically got to approximately this share price? Right? And that's what I mean by an as-is valuation. So we're going to put in assumptions that get us within $1 plus or minus of the current share price. That's an as-is valuation. And that's our first valuation process. So what that means is we're going to go to our model and we're going to start adjusting these ratios so that this forecasted share price is within $1 of basically $41 a share. Okay? Now, there's a lot of ratios that can be changed. I'm going to simplify it to focus on 3. Okay? Now, you can change anything you want, but realistically, these are going to be the most important changes. Yes?
You said we're trying to make this price close to the price where it is right now, right?
That's right.
Like, why would it say that the stock probably is undervalued right now and it's beaten down so much?
Well, you're getting to the second valuation. So people probably in the video can't hear that question, but he basically said, why wouldn't we put in more realistic assumptions to get closer to the share price that we thought it would be worth? And that's what we're going to call the final valuation. So we're going to do 2 valuations. In the as-is, we're going to put in assumptions to try and replicate the current share price, and we may not necessarily agree with them, and that's the point of what the final will be. Then we'll put in the assumptions we think are realistic, and that will create the buy, sell, hold. Okay? But before we do that, we're just trying to replicate the current share price. Right? So as I said, we have to basically look at changing 3 assumptions to simplify it. The 3 simplified assumptions we're going to focus on are revenue growth rate, operating income, and tax rate. Those are the 3 assumptions that we're ultimately going to focus on to keep it simple. Now you'll notice that I'm pretty much skipping the entire balance sheet. The balance sheet, every percentage in the balance sheet ratios is a percentage of sales, which means as we forecast growth in revenue, it's going to forecast growth in the balance sheet and therefore forecast gross investment for the free cash flow. So if we leave the percentages the same, what we're really saying is constant productivity. And that's a typical assumption analysts make for companies. So unless you think the company is going to dramatically change its balance sheet, leaving constant productivity is a realistic assumption. And that's what we're going to do in this case for Coca-Cola. So really we're just going to focus on most of the income statement drivers. And the one that we care about is no plat, therefore revenue growth, operating income, tax rate. Now I'm going to start out with tax rate because with tax rate, we had put in an assumption in the model to use an average tax rate for the last 6 years. And what we really want is a representative tax rate for the company on a go-forward basis. Given the last 6 years, the tax rate hasn't swung that dramatically. I mean, it got down as low as 17% in this year. It doesn't look like an unrealistic tax rate, 22 going forward for Coke. So I'm going to leave the average tax rate assumption as the assumption for tax rate going forward. I might change this if a company were losing money for a few years and had zero taxes or even a tax refund, because that's probably not consistent on a go-forward basis. So I might not want to put that if I averaged it out. Or if the company had to pay a dramatic tax penalty or paid some deferred taxes. So again, I might want to smooth it out differently if appropriate. But in this case, I'm going to assume that this is a reasonable tax rate going forward. So next, what I want to focus on is revenue growth rate and operating income. Okay. Now, here's the thing. I can't directly forecast operating income because that cell is not yellow. Remember I said we don't want to change things in our model that aren't colored yellow because that means that's a calculated result. Right? So how do I forecast it? Well, operating income is a result of revenue minus cost of revenue, operating expenses, and depreciation. So therefore, instead of forecasting operating income directly, I'll forecast one of the other three items as a proxy for changing the operating income. So what we're going to do is we're going to change cost of revenue as a proxy for changing operating income. Right? Now, in the real world, you might get more detailed and you could forecast cost of revenue and operating expenses separately. But for purposes of the model doesn't care because the model cares about cash flow, and the cash flow is going to be based on the operating profits. So either one of those will change the operating profits. So for simplicity, we're just going to use cost of revenue as the number that will change the operating profits. Right? Now, the one number I don't really want to forecast change is depreciation, because depreciation is a non-cash item. So if I change my depreciation, that really won't affect the cash flow of the firm. So that's why I'm either going to do operating expenses or cost of revenue, and I'm choosing cost of revenue. So that's what we're going to use to forecast. So here's the other thing. We have to forecast 10 years worth of revenue growth and 10 years worth of operating margins. And since this is a real world class, it is perfectly acceptable to use the consensus of Wall Street, because there are people on Wall Street who do this professionally that know a lot more about Coca Cola than we probably ever will. And so why create our own forecast and go against the market consensus, particularly for the next couple of years? So what that means is we're going to use Bloomberg and we're going to use the EEO screen and make sure that you use the annual view, not the quarterly view, because this has the consensus forecast that Wall Street currently is making for Coca Cola. So there are 14 analysts who've put in their guesses for Coke sales for next year, 13 for the year after, and the average of those 14 and 13 are the revenue consensus forecast for the next 2 years. Right? Matter of fact, the consensus goes out 5 years. Right? Except what you'll notice is we go from 14 analysts predicting to 13 to 9 to 3 to 2. That as you go further out, every guess is recorded, which means the analysts has increasingly put themselves further on the line for being wrong. So you tend to see fewer analysts predict out more than a couple of years. So what I'm going to say is you can use all 5 years that the analysts have forecast if you want in your own forecast, but you're going to use at least 2 in this class. So we're all going to start out by at least using the first 2 years, because you'll notice company after company, those are the most forecasted. And then years 3 and out, you can either use what the analysts say or you can come up with your own forecast. We are going to at least put in the first 2. So what we're going to care about is the first 2 years of sales and the first 2 years of operating profits. Right? Now, operating profit and EBIT are basically the same number, except what you'll also notice is that more analysts forecast operating profit than EBIT. So we're going to care about EBIT in our model, but we're going to use the operating profit forecast because, again, you'll see more analysts are forecasting operating profit than EBIT, even though they're basically the same thing. All right. So let's go to Excel. I'm going to go to the Assumptions tab, and I'm going to create 4 new assumptions. I'm going to call it Sales 1 for forward year 1, in this case 2013. Sales 2 for forward year 2. Operating profit 1, operating profit 2. And these are all going to be in yellow. And so these are the numbers that I'm going to pull off the EEO screen and just type into my model. So for sales 1, that is going to be 2013 Coke 48,944. For sales 2, 2014, 51,225. For operating profit 1, 11,735. For operating profit 2, 12,647. Okay. So again, what this is representing is the consensus of the market for the next 2 years for Coca Cola's estimated revenue and Coca Cola's estimated operating profits. Okay. So what I want to do in my income tab is I want my 2013 revenue in my model to match the 2013 sales that the analysts are predicting. And the way that we change it is we change it based on the revenue growth rate. So what we have to do is we have to figure out what revenue growth rate gets us that amount of sales. Now we can iterate, which will take forever, or what we can do is we can solve for it. So we know that change in revenue is current year minus previous year divided by previous year. So in this case, that's what we're going to do. We're going to solve for the revenue growth rate. So equals left paren current year, which will be the forecast year, 2000 sales 1, 2013 sales, minus previous year from the income tab, 2012 actual sales, divided by the 2012 actual sales, basically says 1.9%. If Coke grows at about 1.9%, then in our model, 48,944 will be the revenue, which will match the 48,944 of the analyst consensus. Okay? So again, what I'm using on the ratios is from the assumptions, B11, which is sales 1, minus income G3, which is the 2012 revenue, the actual revenue, and I've divided that by income G3, which is the 2012 actual revenue. And that gives me the percentage change. Right? I'm going to do the same thing for 2014. So in 2014, equals left paren, from the assumptions tab, sales 2 minus sales 1. I'm going to divide that by sales 1. So basically, 4.7% is the expected growth rate in 2014 that gets me to 51,225 in revenue, which matches now the consensus. All right, so all we're really doing is we're just using that revenue growth rate to basically put in for the first 2 years what we think it needs to be to match the consensus. So now the model has the consensus for revenue. Right? Next, what we're going to have to do is we want to do the same thing for the operating profit. Except here's what's going to be different about the operating profit. Make my zoom a little bit smaller here. So here's what I'm going to do. I'm going to basically say the first year, I just want to make this relative, that I'm forecasting is 2013, and the second year is 2014. These are just relative years. So again, the model gets updated, they change. I know what the consensus operating profit is. equals operating profit 1 divided by sales 1. And for 2014, operating profit 2 divided by sales 2. So basically, change my format here. That is the operating profit margin that the analysts are forecasting for Coca Cola. The EBIT margin. About 24% in 2013, about 24.7% in 2014. Okay? Based on the consensus numbers. Just operating profit 1 divided by sales 1, operating profit 2 divided by sales 2. That is the number, the operating profit, that I need in my model, my operating income as a percentage of sales to match. That's what I have to match. So in order to help me do this, what I'm going to do is I'm going to say my model operating profit are those two cells. So from the ratios tab, it's my 2013 operating income and my 2014 operating income. Okay? So the consensus is what the analysts are predicting. The model operating profit is what's currently in my model. And I'm going to want those two to match. So in order to get those two to match, what I'm going to have to do is I'm going to have to reduce my cost of goods sold by, in this case, the model profit minus the consensus. So if I reduce my cost of goods sold by that amount, because remember we're using cost of goods sold as the proxy to change operating margin, then my operating margins will match. Right? Now somebody asked me in an earlier class, well, why don't I just directly put this formula in and solve for it like I did the other one into the ratios tab? And the answer is you'll get a circular reference. So this is one where you'll get a circular reference. You can't actually solve for this in the ratios tab, unlike the other one. So therefore, what we're going to do is we're going to have to do this sort of a manual step. So what I'm going to do here is I'm going to go to my cost of goods sold in the ratios tab, and I'm going to subtract 0.0153 for the year 1, which means these now match, which means in the income tab, my 2013 operating income, 11,735, matches 11,735. So what I did is I went to the ratios tab. I just took cell H3, which was already equal to G3, and I subtracted 0.0153, the 1.53%. Because we said that's how much the cost of goods sold would have to go down by, minus 0.0153, in order to get the two to match. Okay. Now I'm going to do the same thing for 2014. Now I have to subtract 2014 by 0.71%. So I can reduce my cost of goods sold there. So in this case, 2014 minus 0.071. 0.0071. 0.071 is 7%. So minus 0.0071. So if I do minus 0.0071, these match, which means 12,647 is now 12,647, the operating income for 2014 that I forecasted in my model. All right? So this was just the process that we were following by adjusting the ratios to get the first 2 years in our model to match the first 2 years that came from the consensus estimates of Wall Street today. All right. And by the way, when we did all that, we're now coming up with a forecasted share price of Coca Cola of $63 a share. And we're trying to get to 41. Right? So that's the point. Now we're ready to try to get to 41. Right? Now, just remember that at this point, we're going into art versus science. Valuation is more about art. And as I said, I've tried to limit our world to there's really two ways that we're going to get to the share price, assuming the tax rate. It's either changing the revenue or changing the cost of goods sold, therefore changing the operating income. Those are going to be the two major ways that we're going to get there. So we have to come up with a point of view when we do valuations. The people that do valuations well have strong points of view about the company. So that's what you're going to have to practice doing next week on your homework assignment and on your group projects. It's your fourth part of your group project, your valuation, is about establishing a point of view. What I mean by that is that when you do the as-is valuation, which is matching the current share price, you have to put in assumptions, and you have to give me why did you use those assumptions? What's your rationale for those assumptions? Now, as you're doing the as-is, you're just trying to understand what could the market be thinking, whether or not you agree with it, but what is the market thinking about Coca Cola? So here's the thing. I know that the share price is lower than what the model shows, so obviously the market's more pessimistic than what the model shows today. Now, what's interesting is if I think about revenue growth rate, one thing I know about Coke is that in 2011, they did an acquisition. So that 32% increase in sales is not organic. It's because they bought somebody. So that's an outlier in terms of sales growth. But those other years, they were just kind of going up and down pretty dramatically. Some years big sales, some years not so much. But here's the thing. Long term, I think one of the concerns the market has is that people are moving towards healthier beverages. And as people move towards healthier beverages, Coke is not as well positioned in those markets, and that could cause some challenges with their growth. So let's start to lower the growth rate and see what the impact on the share price is. So what if the growth rate starting in 2015, and again, I don't want to do the first 2 years because I've already used the consensus for the first 2 years. All right, so I don't want to change the consensus. I'm using the after the consensus. So starting in 2015, what if the growth rate slows to 3%, and then 2%, and then 1%? And then in my assumptions tab in continuing value, the continuing value of the growth also slows to 1%. So Coke doesn't even grow as fast as the economies on a go-forward basis. Well, that's a share price of $40.42 a share. So one point of view that the market could have on Coca-Cola stock is that their growth rate eventually tails down to about 1%, almost no growth, very tepid growth. That explains its current share price. That at the current margins and 1% growth, you get a $40 share price. Right? And that's what I'd be talking about for my as-is. Right? Now, a second scenario that gets me to the as-is valuation is I could say, well, the market might also believe that maybe Coke still grows at 3% into the future. And I'll take my CVG back up to 3%. But they think that the margins will fall. So the cost of goods sold rises. So by 2015, it's 35%, 38%. Something like that. Now, again, there's a couple of different scenarios here, but what it says is that Coke's operating profit margin, which has been in the mid-20s to low 20s, would have to fall to somewhere around 17, 18% to get very close to the current share price. So then I had to ask myself a point of view question, which of the two do I think the market is thinking is more likely? And maybe the answer is a blend of the two. That maybe what the market sees is a little bit slowing growth and a little bit falling margin, and maybe not as draconian as the two, but somewhere in that range is the current market consensus. So, and what I also know is that 1 or 2 points of sales growth is far more significant to Coke than 3 or 4 points of loss in margin. Because their margins are so high, they're going to be very sensitive to growth in sales. And so I think more than anything else, that's probably where the market is with Coca-Cola stock. They're probably more worried about Coke's growth rate. And that's probably what they're worrying about right now, is Coke going to hit the growth rather than is Coke going to maintain its margins. So the scenario that I'm actually going to put in, so I'm going to undo what I just did. Is a little bit more tepid growth, which I think it's going to fall to 2%, and in continuing value, 2%. And in the ratios, I think that the margins are going to fall by getting the cost of goods sold to rise to too much. Somewhere in this range. Call that 35.5. So basically, the margins for Coke, operating margins in the future, are about where they were in 2011, and the growth rate falls to about 2% and continues. So that's what I'm going to call the as-is valuation. So I've come up with a scenario that explains the current share price of Coke. And that's the first valuation that we're going to do. Yes?
If you're adjusting your forecast for these ratios, you also be forecasting forward tax rate change or no?
Again, if you think the tax rate will change in the future, you could, but that's why we're trying to use sort of a representative tax rate that we're going to use for the future. Okay. And again, as you're going through the model, if there's something that you feel you want to change, feel free to change it. You don't have to just take the more limited approach that we're doing. I mean, that's why I put in all those other assumptions. But what I'm telling you is this is kind of the 80-20 rule. These are the things that are going to have the biggest impact in the model, and these are the things the analysts tend to focus on, right? Because that's where the biggest impacts are going to be anyways relative to free cash flow. So therefore, this is coming up with the as-is. So what you're going to have to do is you're going to have to do a write-up and then eventually the PowerPoint for your group projects, which just explains the assumptions. Here's the assumptions I made. Here's why I made those assumptions. So to get the $41 share price, what I basically think the market is thinking is that Coke is going to see its growth rate fall to about 2%, probably because they're worried about their exposure to healthier drinks and the more health-conscious world out there. And at the same time, a slight drop in margin because it's probably going to get some price pressure relative to some of those other drinks, which is going to get their margins at the lower end of what they were, but still maintain them at a pretty good rate in the future, and that gets you to their current share price. All right, so you're just trying to give an explanation for what could explain the current share price. Questions about that? Yes?
How will we be graded then? Like, should we just justify our assumptions?
Yeah, I can't grade you on whether or not you're right or wrong because we're predicting the real world in the future. So what I'm really grading you is, are you following the process and do you have a defensible story? So it should be somewhat fact-based, meaning when you really do this, we should have used the IBIS report because in the IBIS report, it gives you a 10-year industry revenue growth forecast. So that would definitely help us as we think about the revenue growth forecast, particularly in the out years. Right? And I kind of shortcutted that for the interest of time today. So you definitely want to use the IBIS World Report. You should have read the analyst reports, all right, for the companies. Pick a couple of the analyst reports, read them. Read a JP Morgan report, read a Credit Suisse report, read a Deutsche Bank report. Those are freely available on the portal in the Thomson One product. And again, I can show you how to get to those a little bit later. In addition, you should, beyond doing that research, you should then apply that to what you think is reasonable in creating a forecast. So as long as it's somewhat fact-based, and again, you also have the historical analysis. So you've done the 5-year CFI. You have a sense of the range of margins the company has achieved historically and how they've been changing. So somebody asked before, it's kind of gut feels like, yeah, but your gut should have a much better feel after doing that extra analysis. And that's really the art of the valuation. So that's what I'm saying. As long as you can give me sort of a defensible series of assumptions, that's what I'm grading you on. It's more the process than the absolute result. Because there could be disagreement. Now, you still have to come up in the as-is with a current steer price, right? And how we get there could be slightly different. Because like I said, one person could do it by, oh, it's just a revenue drop. Somebody else could do it as a margin drop, and both could technically be right. Yes?
Is there a reason when you were making these assumptions that you did it, like you would keep something for 2 years rather than changing year to year?
Yeah, I think, and again, look at the historical trends of the data. So again, for people in the video, if you didn't hear that, he just said, why did I wait 2 years before I made adjustments rather than over 1 year? Is that generally companies don't usually have abrupt changes, and I try to smooth them out over time. So even if I see the margin eventually dropping by 3 or 4%, it'll probably slowly drop rather than absolute. So it's more just to smooth out the data than try and do it all at once. Just try and be more realistic. Okay. Unless I think something's going to happen to a company overnight. I mean, in that case, it could be abrupt. I mean, look at what happened to, poor Nokia or poor Research in Motion in the cell phone market. I mean, the floor dropped out from under them. I could forecast that, but I don't think that's realistic for a company like Coke. Okay. All right, so this is the as-is valuation. So now what I'm going to do is I'm going to save this file, and I'm going to rename it the final valuation. So this is valuation number 2 that we'll have to do. The difference between the as-is and the final is in the final valuation, I'm now going to enter the assumptions that I believe are reasonable. All right? So in the as-is, I'm trying to back in to what I think the assumptions needed to be to justify the current share price. When I do the final valuation, I'm trying to put in what I believe the assumptions are to create a share price that I think is more reasonable for Coca Cola. Okay, so this is now my point of view that I'm coming up with. So that's the point. What you're going to have to do is you're going to put in your assumptions, explain your assumptions, why you chose them, and what assumptions you made that got you to the final valuation. So my belief with Coke is that I think they are going to probably see slower growth, but I think they're going to grow with the economy. So instead of 2% in the as-is, I'm going to raise it to 3%. And in the continuing value period, I'm going to raise that back to 3%. Well, that gets me a $49 share price. Right? So here's what I'm going to say about my final valuation of Coke, which is I actually think that the margins of Coke could easily drop a couple of points from where they are in the forecast period that the analysts are forecasting the increase in margins, that Coke could lose that increase over the next couple of years due to more competition, particularly from healthier beverages and alternative drinks. So I could foresee that their margins actually approach where they used to be. But I also think that Coke's growth, though may slow, may not slow as much as the market thought. But even if that occurs, I'm now at a $49 share price. So I think Coke is intrinsically worth, assuming these are my assumptions, $49 a share. Now, buy, sell, hold. Because $49 a share in my final valuation is more than 10% above the current share price, right? 41 plus 10% is about 45, then I think it's worth buying Coke. Because I'm getting something that's worth 49 at a bargain price of 41, so I think now is a good time to get in. And over time, the value of Coke should eventually trend up towards 49, right? So buy. That's the reason to buy. If I came up with a scenario that was between 37 and 45, plus or minus 10%, then I would say hold. Because I would say, you know what, that's just too much of a trading range for a company stock to really want to try and get in to make a couple of points. If it's less than 10%, in this case less than $37 a share, then I would say sell. And that's how you do the buy, sell, hold. Okay. Now some analysts use a 15% range. We're going to use a 10% range. All right, but that's basically the idea of the buy, sell, hold. And that's exactly how you do it, which is you look at the current share price, you look at your forecast share price, you look at the difference, and that creates the idea of buy, sell, hold. Okay, so that'll be one of the final things you'll do for your valuation. So for your valuation, you'll do the as-is, you'll put the data in, you'll put the assumptions in for the as-is, you kind of explain, hey, these are the assumptions I made, kind of why I thought I made them, what the market must be thinking. Here's the assumptions I changed for my final. And as a result, this was my final share price, and that created the buy, sell, hold. So I say, fill in the blank. Okay? And that is almost everything you need to do in the valuation. Okay? With one final exception. But before we get to that exception, just is everybody clear on how we got to this point? Okay. Here's the exception. The ROIC chart. Right now, in the model that we have a graph of the historical ROIC of the company. And what we want to do is we want to add to this graph the future ROIC. So I don't know an easy way to do this, so what I'm just going to do is redo the chart. So I'm basically just going to delete the chart, delete the whole sheet, and add a new chart sheet. So I'm going to go back to the EPBOY tab. I'm going to get rid of column B. Just going to delete it. And I'm going to graph row 15, which is the beginning of year return on invested capital for the company. Right? And then what I'm going to do is I'm just going to insert a new sheet, which is a chart sheet. And I'm going to make this a line chart. But this is basically the 11-year forecast of the ROIC plus the 6-year historical ROIC. So it's basically 16 years of ROIC. Yes?
Could you repeat how you got the graph in after selecting the ROIC?
So I just insert, well, I have a Mac. I don't know if the Windows version does the same thing. Insert sheet, chart sheet. Now, if you don't have the ability to insert a sheet very easily, you can just put the chart into your own sheet, like create a sheet, put the chart sheet there, or put the chart, create the chart in the same sheet, and then copy and paste it, or cut and paste it to another sheet. But the point is, you want to have a graph of the historical ROIC. Matter of fact, to line up the years, if you select data for the x-axis labels, select all the years. So go from B1 to, in this case, Q1, because I got rid of the extra year. Hit OK, and then it'll have the years along the bottom. Right? But here's the real point of this. The final part of your evaluation is this ROIC chart, because this ROIC chart is our sanity check. Right? We know that over time that the ROIC of a company should regress towards the mean. Right? So that's what we would expect in the out years for the ROIC. What we don't want to see is what I would call a hockey stick. We don't want to see the ROIC of the company in the out years start moving back up like this. Because if it starts moving back up like this, then that sort of defies what we expect about firms when they go to maturity, particularly in competitive markets. So I'm not saying it's impossible. There are companies that could be doing much better in the future than they are today, right? But that would be an exception, right? And that's what we would have to defend. Why, if I thought my ROIC was dramatically increasing in the future, why would I believe that's the case? Because that's not likely for most companies. So most companies would see flat or trending down ROICs in the long term as opposed to trending up. So here's the final part of your project and your assignment next week is you have to show me the ROIC chart and you have to defend it, right? And so basically to say, here's my final valuation, here's the ROIC chart for the final valuation, and here's why I think that this is reasonable. And in this case, even at a $49 share price, which is what this ROIC chart is graphing, that's the $49.20 stock price. then even at that share price, I have a flat ROIC into the future, and at the same time, substantially lower than what Coke historically had done, but within a range of what Coke has been doing in the last couple of years. Right? So I think it's actually reasonable for a company like Coca Cola, which has a great brand and probably a lot of competitive advantage, to maintain their ROIC into the future. Right? And so therefore, I think that this is actually a reasonable chart, right? And therefore a reasonable share price. And so that's what I would say. Right? So that's what I'm just saying. Use this as your, what I'll call, sanity check, right? As opposed to this. So I'm going to save this. Watch what happens to the chart when I start doing this. So I'm going to go back to the ratios. This is what's called a hockey stick. I mean, it's not exactly a hockey stick, but it's kind of moving up in that hockey stick-like direction. And that's what you don't want to see in your out years. This is not reasonable. All right? I'm not saying it's not possible, but it's highly improbable for most companies. Because what you're saying is that the far future for a very large company that's more likely to be mature is going to be far better than it was in the past. Right? And that is unlikely. Right? So if you do your valuation, you show me this, I'm going to be very skeptical of your valuation. All right? So that's what I'm saying. Use this as a reasonable assess. By the way, this would be a share price of $83 a share. So the point is Coke going to be at 83 anytime soon? Probably not. All right? Could Coke be at 50 anytime soon? Possibly. All right, so I think 50 is probably a reasonable stock price for Coke. 80, probably not. Because what would have to happen for Coke to get to $80 a share is very unlikely. Right? And so that's the way that I want you to think about the valuation. So that's your sanity check to make sure that we don't go too crazy with the assumptions that we change. So we're kind of graphing out what the return is based on our assumptions to make sure that we're putting in reasonable rates of return. So I'm going to undo this. Going back to the $49 share price, and again, go back to the ROIC chart. Again, that chart seems much more reasonable. Okay. All right, so what we've done today is we've completed the as-is valuation. We've completed the final valuation. We've updated the chart, so now it has 16 years on it instead of just the historical years. And so essentially, we have finished the valuation model. So we now have the complete valuation model that we're going to use for this semester. And as I said, it is now essentially a reusable model. Okay? So this is going to lead into next week's lab assignment. So it says case study on the syllabus. And so basically the case study doesn't mean the group case study. The case study means you're going to work in the lab next week on a different company. So what's going to happen is I'll give you a company. I haven't decided which one it is. All right, but let's say it's Walmart. So what you'll do is you'll go to the lab, you'll log into Bloomberg, you go to Walmart. And I will do another video on this which explains the process for pulling the data. But one thing you'll do is you go to the DES screen, and this will give you the shares outstanding and a reminder of the current share price at the time you did the valuation. You'll go to the weighted average cost of capital screen. This will be the weighted average cost of capital that we'll use in our valuation model. You'll go to the EEO screen. Make sure you get annualized data. This will give you the forward sales and the forward operating profits for the forecast for the first 2 years. You'll then go to the FA screen where you'll get the historical data. You'll go to the income statement. You'll output it to Excel. You'll go to the balance sheet. You'll output it to Excel. And you'll go to the cash flow statement. You'll output the cash flow to Excel. You'll then take that Excel data, you'll update the model. So you'll copy and paste it in the model, take the data from the screenshots, put that in the model, and then you'll be able to value the as-is and the final of the other company. And the model will set up the CFI. The model will set up your ROIC tree automatically. And then the last piece is you'll have to do the comps, right? Just like you did in the last homework assignment. So like I said, it'll be a lot, essentially the equivalent of 3 assignments. That's why it's going to be worth 5 homework points next week. And because I know it's a large assignment, rather than coming in and doing it in class, it's individual, I'm going to give you time to work on it in the lab. So as I said, I'm going to ask the TAs and myself to spend time in the lab next week so that you will be there to help and ask questions. But as I said, no class on Monday, no class on Wednesday. Deal with it in the lab. Assignment we do the following Monday. We'll debrief that company the following Monday. And the following week, we'll do another company. Okay, so that'll be the plan. So really, the next 3 weeks, up until your group projects, are just going to be practice.